Cheap valuations, premium commanded over peers, and the recent net outflow from mutual funds. None of these factors have managed to stall Indian equities from scaling new highs. And one organization that sees the Sensex gaining another 3,000 odd points from here is Morgan Stanley. So what's fueling this optimism? Well, let's ask Ridham Desai, the head of India Equity Research at the investment giant, joining us on the show. Ridham, good having you. Thanks much for joining in.
Thank you.
I remember that line that conditions are not conducive for an up move, but prices are. It may have been a labored move, but it's happened. What next from you?
You're very kind. I've said other things also which have gone horribly wrong. So I get a few right, few wrong.
Everybody does.
This time it has been more in my favor. Next time it won't be. So you take all these things with a pinch of salt.
I'll remind you then that also, not a problem.
Hopefully you do. But one of your colleagues, while I was waiting to come here, asked me, so when will all this end? And I said that till the time you ask me this question, it's not going to end. So, there's still a fair bit of skepticism out there. I don't think people have participated. It has been all too quick and swift, and there was too much of pessimism over, say, October, November, December, to a little lesser extent, Jan and Feb. So I think that pessimism is still there in the air. It's not gone away, and therefore I think the markets may have a little bit more to go in the short run. Equities, I think, remain a long-term asset class. These things keep happening. They go up and down in the short run, but investors are best advised to just hang on there and create a retirement fund out of equities.
It's interesting you say that, because up until 2 or 3 months ago, your top index target would have been 11,500. No one even briefly mentioned rescaling the previous highs. But my question to you is, obviously
we started the year with 42,000, which looked very outrageous. But the point that I was making then was that the ballot will fade in importance by the time June comes. So I was not even making a call on the elections. Usually I don't get into that because calling elections is very hard. So my the premise was that India's growth cycle is turning. And to that extent, the bid will come back to equities at some point in time. It came probably a little quicker because things changed on the political front. I still feel the ballot will fade in importance, and what will matter starting, the end of May is how India's growth pans out, which is looking okay. And the only caveat there is oil, and we have to keep an eye on it because oil is going up for supply side factors, not demand. Supply is dominating, and that's not a good thing for India. So if oil keeps going up, then it will create a little bit of a headwind. Sorry, you were asking something, I interrupted you.
No, so I was actually asking you that obviously while we know that this has been a big liquidity-driven rally, has the retail participant been sort of sidelined in this entire up move?
I was doing some math. We've had $6 billion of issuances since the start of the year. And actually institutional flows on a net basis have been less than that, foreigners plus domestic. So it means that retail is pretty much there. Yeah. Otherwise you wouldn't have been able to do 6 billion of issuances. That's a pretty solid number compared to last year, coming in the first quarter of this year. So very clearly, I think it's actually...
This has happened so quickly in the last 1 month, where almost on a daily basis, you've seen big money coming in.
So I dare say this... So firstly, flows lag prices, okay? So let's not think that flows drive share prices. Prices went up. There's a small lag between flows and prices. So prices go up, the bid comes back, and then flows come in. The bid is different from flows. The bid is psychological. Okay, the same shares were trading at a 20% lower price a month ago. Nothing has changed, and the prices have, because the psychology has changed. And that psychology is about confidence in the future of the company or the markets or the economy. So that is a combination of various market participants playing. And I would say that retail or HNI or high net worth has been as involved as foreign investors in the last, say, 2 months of the move. And that's evident in the way the broad market has moved.
Yes.
Okay, it's not just a large cap rally, it's a pretty broad-based rally. So it's really psychology is back. Nothing has changed except the psychology. And that is that I have more confidence in India's future.
Yeah, the good part also is that mutual fund NAVs are back to what they used to be. So the retail investor in that sense has probably benefited. But, since you made a point of foreign investors, Ridham, just wanted to know, two or three other guests that we spoke to mentioned that their clients who are India-dedicated funds haven't gotten major inflows. There's more ETF money that has come into India, which was not the case in February when the other EMs got the money. Is that the case? And therefore, part two of my question is, would you reckon that India-dedicated funds will start getting in money looking at this outperformance, maybe looking at political stability or otherwise? And would that play a part in driving up what is already a very expensive market to even higher levels?
And also add to that, India dedicated funds, are they even that sizable, and will they get sizable apart from the fact if you remove them from the emerging market allocation that comes in?
Lots of questions. So firstly, I'll take the valuation one. So we'll keep that aside. I don't think the market is rich.
Why?
Yeah, it's at 3.2 times book. That's bang in the middle of its historical range of 2 and 4. Now you will cite me the PE ratio, but I've said this often in the last few quarters or few years that the earnings are very depressed versus history. So if you want to look at PE, then you normalize the earnings. Earnings are not secular, they are cyclical in nature. So it's not like a consumer staple company where the earnings invariably go up every year, and therefore PE is a good metric or is a reasonable metric. For the market as a whole, the earnings go like this. This market has seen an earnings drawdown, which is unprecedented in India's context. It was down 22% from peak to trough. That's a very big decline in earnings. Whereas over this period, if you use historical averages, the earnings should have actually compounded at maybe 13-14% every year. So that's a big fall in earnings versus trend. And how do we know this? We measure the profit share in GDP, and that's actually at the level that it was last seen in 2001. So the market is not rich. I don't think it is cheap either, but it's somewhere in the middle. So it knows kind of that the earning cycle is going to turn, but is not fully pricing in what could be a ferocious earning cycle over the next 5 years. So we could see earnings compound at 20% for 5 years, and I don't think that's in the price. So as far as valuations are concerned, I don't think the market is rich. It actually gets even more interesting if you look at the broad market. So one of the ways of measuring this is to use market cap to GDP, and we're actually quite comfortable at about 70%. It's not outrageous. Okay, this market has traded over 100% in the past. So we have some journey to go for valuations to get worrying. Then the point on foreign investors, I think that's also what I'm hearing. It's hard to actually authenticate this with data because you don't get granular data of the flows. That there's been a fair bit of passive and ETF money that has come in over the last 2 years. Now this is the good news, because active fund managers have trimmed their positions on India to 8-year lows at the end of last year. It has now come back a little bit from there, but it's still pretty low relative to history. So I would say participation in India or exposure to India is a little lower than history, and therefore it has room to actually go up. So that means there's more money that is waiting to come. And based on the anecdotes, pure anecdotes of the conversations I am having, this feels like 2004. The type of people who want to know a little bit more about India, what's happening, what will happen in the elections, what's happening to growth, what's going to happen in the next government's economic agenda, etc. It feels like 04 in the sense that some different type of people are now getting interested.
Interesting.
Yeah.
And so the big elephant in the room, or the big question, do those people will stay interested even if the current dispensation doesn't come back with a thumping majority? That anyways doesn't seem to be the case, but nevertheless.
See, if India decides to vote a fragmented government, there will be a correction, because now the market is increasingly pricing in a majority or a near majority, let's say. Not necessarily a majority, but a near majority, that the next government is going to come in with 250 seats or 240 seats and will be able to get another 30-40 seats and form a government. That's now getting increasingly priced in. Maybe there's a few more points to go before it's fully priced in.
Right.
And that's the risk. Any event, when you go into that and it is priced in, the risk is that the market sells off. So I dare say I hate to make these short-term calls, but yet I make them. This quarter actually may not turn out to be a very good quarter in terms of share prices.
For prices, okay.
Yeah. So India may underperform emerging markets. Okay. Because what will happen is by the time we get to the end of May, the market may have already priced in the election outcome, and then you will get some correction in June. So again, I hate to do this short-term thing, but if you are a trader, you actually want to sell this as it crosses an all-time high. It will actually probably, now that it has touched an all-time high, actually make a move ahead. And then at that time you want to lighten up and then wait for the elections to get over and then come in. That's the better risk management for a trader. This doesn't apply to investors, but for a trader, I think the next few weeks I think will give you an opportunity to exit and then come back at a later stage. So if India decides to vote in a fragmented government, I think you'll get a perceptible correction in stocks. Going by what I feel is going to happen in the next 4-5 weeks, which is we're going to fully price in a majority government or a near majority.
Which is interesting because we're just down 3 months this year and we're already at a record high. We have the remaining...
Okay, record high is not relevant at all because by its very nature, equities tend to over time gain, so they keep making new highs, right? So,
but from an investor's point of view, okay, while you spoke about traders, from an investor point of view, keeping the factors that you mentioned, it would not be late to still make investments, right?
Equities, I think... See, from an investor standpoint, really, the time to buy is when the sentiment is terrible. Okay, so the time to buy was between October and February. That's when you had a lot of... No, you don't miss the buzz, but that's really the juicy stage. When you get into stocks when they are hammered and nobody wants to buy them, there's a lot of ego satisfaction you get when the rally comes. So now you don't have ego satisfaction. I think now you have returns, but obviously they're a little less than what they would have been had you bought in Jan and Feb, but then it takes enormous amount of courage and patience to participate when the market is falling. So when the market is rising, it's a lot easier. I think there are still a lot of stocks that look pretty depressed relative to fair value. So there's still a fair bit of juice left in those, and those are the ones that will actually outperform, like industrials, like consumer discretionary, like auto stocks, and to some extent non-banking finance stocks. They are still well off their highs or fair value. So there's still a little bit left.
But the sentiment still is not changed for you to, take coherence of the depressed prices and say, okay, I'll start investing right now at these.
No, I think it's never too late to invest in equities. I was just looking at an investment that I'd made for my daughter in 2000. Bad year to invest, right? That's up 7-fold in a balanced fund, which is in compounded annual return of about 12%. Not a bad outcome, even though I invested at the high of the market.
Yeah.
So I think it's okay. It evens out over time if you're a genuinely long-term investor. If you had invested at the peak of the market in Jan 08, which in the subsequent year turned out to be a terrible decision because stock prices fell like 50-60%, you're okay, right? You're coming out now fine in 10 years or 12 years. But you have to have that genuinely long-term view, and ideally it should not be the only occasion you buy. So hopefully if you bought at 21,000 in Jan 08, then you again bought later on in 2008 or in 2009, and then your returns are actually quite good.
Interesting. Okay.
So buying at an all-time high, sorry, I'll just finish the point. It's not a problem. It's not a problem. For an investor with a 5-10 year view, I don't think it's a problem. I think the chances are that India will do well as an economy and as a stock market, and therefore over 5-10 years you will make more than your adequate returns. And certainly equities, I think, will eventually outperform bonds, fixed deposits, and real estate.
Okay. Turning focus back to maybe institutional clients, and just wondering if you have a large set of clients asking about what to do with the heaviest weightage index right now, what would your advice be? The valuations, while we talk, and okay, let's put this into perspective. I take on account that maybe the price to earning multiple for the Nifty is the wrong way to look at it. Banks have had near steady secular earnings growth, and there the valuations price to book for large quality NBFCs or large quality banks are high.
Maybe a couple of them, not across the board. The banks that...
Okay, maybe not corporate facing.
Let's put it like this. I don't like to use corporate and retail because that distinction no longer exists. Banks do everything, okay? So let's talk about the banks that bore the brunt of the previous NPL cycle. They're trading somewhere between 0.5 and 2 times book. Okay, with potential return on equity between say 10 and 15%. That's okay. I mean, you're entering into a pretty strong earning cycles for these banks. They may end up doing 50-60% compounded annual earnings growth for the next 3 years because there's really no credit cost that they have to charge their P&L. So it looks like a pretty good environment for these banks, and therefore you'd still make money from these levels. There could be a couple of stocks which, banks which have very high return on capital and therefore, command a premium. But those are very high quality businesses as well, and they have been they've been rewarded because they did not participate in the NPL cycle. So I think it's okay. I mean, the banks don't look rich to me at all. In fact, I would say the banks are not the problem. The only segment of the market where valuations are rich and the stocks refuse to actually sell off are consumer staples. But now they have started to underperform. Like consumer staples underperformed significantly in the month of March. And that was, as the rest of the market play catch up.
No, but my question was not about whether banks will sell off or no, Ridham. My question is, tactically speaking, where within this whole wide spectrum of financials and not just banks, would large money find comfort in coming in?
Okay.
Would it be those expensive names? Would it be the quote-unquote corporate-facing banks, or would it be something else?
See, I think there is still some anchoring to the performers of the last 5 years. There's still some anchoring. And therefore, there will still be some money left to come into those banks, or in fact, any company that has done well over the last 5 years, it was last 7 years, it was a pretty tough economic cycle. And if you've done well, then that basically underpins strong management, strong businesses, you have a strong moat, you've done well, people will back you. But I think money will also come into those which have underperformed in the last 7 years if the economic cycle is turning as I feel it is, because those are the ones that will produce the delta in earnings. So I think you're going to get a mixed bag in the middle, in the beginning, and then as those laggards start outperforming, I think more money will come into them.
All right. Let's talk about the other two themes that you just mentioned, your consumer staples and auto as a pocket. Very depressed right now. Sentiment seems to be just too negative with regards to the month-on-month volume numbers that have been coming in. Even on-ground situation doesn't seem to be picking up. How do things change from here on? And anything interesting that suggests that now is the time to look at these pockets?
Yes, certainly. I think the auto stocks are going through that November moment. Environment is not conducive prices. So I am bulled up on autos. I'm buying all of them. I think you will see that the data will turn. They've gone through idiosyncratic issues. I think they underestimated the impact on demand coming out of the liquidity crunch that the economy faced briefly between, say, October and January. So the inventory in the pipeline got stuffed, and now they had to wind that down. I think secondary demand is actually okay, but there's too much inventory, and consumers are very smart. They know this is the time when they can eke out discounts because people want to flush out the inventory. You had that insurance problem, then there are some changes happening to emission norms. So a few things got bunched up. I think they'll settle in the next couple of months. So I'm actually quite bullish. I think, now is the time to buy auto stocks.
So you don't think it's an NBFC problem with the loan dispensation, which is causing a little bit of a drag in terms?
It was, and I think that's now the worst is behind us.
Okay.
I think in November, a lot of people thought NBFCs will collapse, and that's not happened. But NBFCs are certainly slowing down in terms of growth because whatever happened between September and January has forced them to increase liquidity on their balance sheets and increase capital, which means they have slowed down growth. And to that extent, demand has been affected, and some of that growth will be taken over by the banks. But NBFCs are probably going to grow a lot slower this year than they did last year or the year prior, or what was baked into share prices, say, in September. Now I think the markets are far more, I would say, pessimistic about NBFCs. It's not such a bad environment, actually, because I sense that the central bank has shifted its stance. Dare say that central bank kept real rates a tad too high because they had an inflation target starting 2015. So it was but natural that the central bank was pursuing that target and to make sure that it did not miss it. It is possible that they kept rates a little too high, and I think we heard the RBI talk about this in the Fed policy, that their inflation forecasts have gone wrong, which is essentially that we were keeping rates for a higher inflation rate so that we don't miss the target. Now I think you've successfully met the target, and I think the recent actions from the RBI, like the dollar swap that they have initiated, to my mind suggests that they are a lot more accommodative to growth and inflation. So they are a little bit more relaxed about the inflation environment. So that's good for our NBFCs because liquidity, I think, will improve.
Actually, my question was more on the lines of the auto finance companies, the NBFCs there, curtailing offtake to investors who want to start making purchases in your cars.
Yeah, so I think the worst is over. Now, auto financing is not such a unique product for only NBFCs to pursue. Even the banks can do that.
Yeah.
So to that extent, actually, this is positive for the banks because some of that space which was being heavily competed by NBFCs has been vacated by NBFCs to some extent. Same thing in housing. So the large NBFCs or the banks who have got, or the NBFCs who have got good deposit franchise and are not hurt by this liquidity will gain share in housing finance as well.
Okay. My final question, Ridham, and that's the worldview. Couple of things have changed from 2018, the Fed commentary, but also what's changed, and I think IMF commentary yesterday as well, speaking about how fragile the world outlook is looking on growth. You started off our conversation saying that the India growth numbers still look okay. What if the world, for lack of a better word, starts underperforming on growth? But there is this cushion that the central banks provide. How do you read those situations and what's the impact there could be?
I think there's a material shift in the Fed outlook, which has probably put a floor to the US growth rate. So if you go back to the start of the year, there was a greater risk of a US recession. We had put it at 30%. We just lowered that to 20. So if anything, we're actually becoming a little bit more optimistic about growth. We're very optimistic on Chinese growth. We think there's been a fair bit of action by Chinese policymakers to offset the US-China trade tensions, which will cause China's growth to actually accelerate. And if something gets resolved on the US-China trade front, which looks increasingly likely as time passes rather than not, I think we'll probably be surprised slightly on the upside with global growth. And to that extent, it brings a little bit of a risk to India because it gets accompanied by higher commodity prices, notably oil, and that does put a bit of a lid on India. So, it goes to the comment that I made that this quarter, India may end up underperforming EM, is actually linked to two things. One is our own idiosyncratic election event, and the second is the fact that I think the world may actually be quite okay. And if global equities need to price in more growth, then India is, when we just last checked, India's correlations with world equities have turned negative. So if the world is doing well, India will likely underperform. Okay, it will not fall, but it will underperform. And that could be the template for this quarter. We are very bullish on EM, we are bullish on Japan, and we have turned bullish on Europe. The only market that we are still not constructive is US. So it's a pretty constructive view that Morgan Stanley has on global equities. And India will do well on an absolute basis, but may have to take a few periods of underperformance while that gets rolled out.
All right, before we wind up this interview, Ridham, just one big opportunity for Indian equity investors and one big threat, according to you, in your mind.
In terms of macro factors?
In terms of anything, whether it be earnings, whether it be growth, which will impact Indian equities in a meaningful way on the upside, or a threat which would cause a bigger collapse on the downside.
One big, right? I shouldn't say some things that people normally say. I think an appreciating rupee could be a problem. And given that the RBI may have...
It could be a problem.
Yeah, so given that the RBI has more dollar swaps in the pipeline than just the one they've done, they've announced a second one, there could be more. And I think given that FPI flows, I think will be quite strong. If oil is kind of well behaved, India's BOP will look very good this year compared to last year. And to that extent, the rupee may face upward pressure. And when that happens, it taxes earnings in India. So I'm not. I don't want the rupee to gain too much in real effective, exchange rate basis, which is it should not be up while India suffers an inflation differential with the rest of the world. That could put a little bit of strain on growth. The second thing I think, so that could be a threat. The opportunity is that I think, notwithstanding the new high that we are seeing this morning, I think psychologically the market has not fully repaired. So we may be surprised on the upside as to how much more this rally may have before it gives its first decent correction. Because people will feel left out and will come to participate. And I can see that everywhere. I can see that in my office. Nobody bought shares in Jan and Feb. Now they may actually scamper for cover as markets continue to gain. So that could be your big surprise for this quarter, which is that I go wrong and stock prices are materially higher and India has no problem outperforming the world.
Well, let's wait and watch if that happens. But Ridham Desai, pleasure chatting with you today. Thank you so much for taking the time out.
Thank you.
Thank you.
Viewers, thanks for tuning into this leg of BQ Conversations.